$113.88 per ounce. That's what someone in India paid for silver today, right now, while I'm recording this video. Meanwhile, here in the United States, silver is trading at $93 per ounce on the COMEX. Same metal, same silver, same 1 troy ounce. $20 difference. Now, if you've never traded commodities before, let me tell you something. That's not supposed to happen. In efficient markets, prices converge. If gold is cheaper in New York than London, traders buy in New York and sell in London until the prices equalize. It's called arbitrage, and it happens in milliseconds thanks to computer algorithms. But today, on January 21st, 2026, the Indian silver market hit $113.88 per ounce, while COMEX sat at 93. That's a 22% premium, and it stayed there for hours. That doesn't happen in a functioning market. That happens when something breaks. Welcome to the hidden economy, where we cut through the noise and show you what's really happening in global markets. I'm here to break down the events that mainstream media either ignores or doesn't understand. If this kind of analysis is valuable to you, hit that subscribe button and turn on notifications. Because what I'm about to show you explains why the global silver market is fracturing right before our eyes. And when markets fracture, that's when generational wealth is made or lost. Let me start by showing you exactly what happened in India, because this isn't just a one-day price spike. This is panic. This is fear. This is what happens when people realize that paper promises might not be worth the paper they're printed on. The MCX, that's the multi-commodity exchange of India, it's their version of our COMEX. And on January 21st, silver futures on the MCX exploded to 335,521 rupees per kilogram. When you convert that to US dollars per ounce, that's $113.88. Now here's what you need to understand about India. India is the second largest consumer of silver in the world after China. Indian culture has a deep connection to precious metals. Silver is used in weddings, religious ceremonies, jewelry, and as a store of wealth. When prices drop, Indians buy. When prices rise, they buy more because they view it as an investment. India imports massive amounts of silver every year. In 2023, they imported over 7,500 tons. That's roughly 240 million ounces. To put that in perspective, global annual mine production is around 850 million ounces. So India alone absorbs about 28% of the world's newly mined silver every single year. These aren't traders speculating on price movements. These are physical buyers who want the actual metal. They take delivery, they store it, they hold it. And when they panic buy, they move markets. So what triggered this panic? According to reports coming out of India, there's a rumor that the Indian government is about to implement import tariffs on silver. Now, I can't confirm if these rumors are true. The government hasn't made an official announcement, but in markets, rumors are enough, especially when those rumors make sense given the broader context. India has been dealing with currency pressures. The rupee has weakened against the dollar over the past year. When your currency weakens, imports become more expensive. And when imports become more expensive, governments sometimes impose tariffs to protect their currency and reduce trade deficits. If India implements a tariff on silver imports, let's say a 10% tariff, that immediately makes silver more expensive for Indian buyers. So what do rational actors do when they hear a tariff is coming? They rush to buy before the tariff takes effect. They front-run the policy change. And that's exactly what we saw. Indian jewelers, dealers, and investors rushed into the MCX to lock in silver before potential tariffs make it more expensive. That surge of buying pushed prices to $113. Now, you might be thinking, okay, that's a panic spike in one country. Prices will come back down once the panic subsides. And normally you'd be right. But here's why this is different. The $20 premium didn't disappear. It persisted. And that tells me this isn't just about tariff rumors. This is about physical availability. Let me explain something about how global silver markets are supposed to work. There are 3 major trading hubs: the COMEX in the United States, the LBMA in London, and the Shanghai Futures Exchange in China, which recently added the MCX in India as a major player. In theory, these markets should trade at roughly the same price, adjusted for currency exchange rates and small premiums for transportation and insurance. If silver is significantly cheaper in one market, traders should buy there and sell in the more expensive market until prices equalize. But on January 21st, look at what happened. India traded at $113. China's Shanghai Futures Exchange closed at $102.78. The COMEX in the US traded at $93. 3 different prices, 3 different markets. Same metal. India is $20 above the US. China is about $10 above the US. These aren't small premiums. These are massive gaps that should trigger immediate arbitrage. So why isn't arbitrage working? Why aren't traders buying silver in New York at $93 and selling it in India at $113 for an instant $20 profit per ounce? Because they can't get the physical metal out of COMEX fast enough. And even if they could, shipping it to India takes time. And in that time, the premium might disappear, or tariffs might take effect. Or worse, they might not be able to source the physical silver at all because inventories are so tight. This is what a shortage looks like in real time. When premiums explode and persist, it means the physical metal isn't available at the paper price. It means the paper market, which is COMEX, is disconnected from physical reality. And this isn't happening in a vacuum. Remember the video I did 2 days ago about the COMEX vault withdrawal? 4.2 million ounces of silver vanished from COMEX depositories in a single day on January 16th. Registered silver, the stuff that's actually available for delivery, dropped by 2.5 million ounces. Now, just 5 days later, India is paying a $20 premium for physical silver. You see the connection? The physical metal is leaving the COMEX system, and the places that need physical silver, like India and China, are having to pay massive premiums to secure supply. Let me show you the bigger picture here, because this isn't just about one day's price action. This is about a structural shift in the global silver market. For decades, the COMEX has been the price discovery mechanism for silver. When someone asks, what's the price of silver? They look at the COMEX spot price. Banks use it, dealers use it, investors use it. It's the benchmark. But the COMEX is primarily a paper market. It's a futures exchange. Most contracts never result in physical delivery. Traders buy and sell contracts, and they settle in cash. It's a betting market on price movements. The problem is that the COMEX controls the price, but it doesn't control the physical supply. The physical silver is in vaults, refineries, and private hands around the world. And increasingly, that physical silver is in Asia. China is the world's largest producer of silver. They mine about 115 million ounces per year. But they also consume about 200 million ounces per year for their massive electronics, solar panel, and EV industries. So China is a net importer, despite being the largest producer. India, as I mentioned, imports over 240 million ounces per year. Between China and India, you're talking about 450 million ounces of annual demand from just two countries. That's more than half of global mine production. And both of these countries prefer physical metal. They're not trading paper contracts, they're taking delivery, they're accumulating. Meanwhile, the COMEX registered silver, the deliverable stuff, is down to 120 million ounces. That's less than 3 months of supply for China and India combined. So what happens when the East wants physical and the West is trading paper? The prices diverge, and that's exactly what we're seeing. India at 113, China at 102, US at 93. The premium is in Asia because that's where the demand for physical metal is. Now, let me give you my personal view on this because I've been covering precious metals for years, and I've never seen a divergence this large that lasted this long. In my opinion, the COMEX price is artificial. It's not a true reflection of physical silver's value. It's the price of a paper contract that represents silver. But increasingly, people don't want paper contracts. They want the actual metal. When you trade paper silver, you're exposed to counterparty risk. You're trusting that the institution you bought from will actually deliver the silver if you ask for it. You're trusting that the vaults have the metal. You're trusting the system. But trust is eroding, and when trust erodes, premiums explode. The fact that India is willing to pay $20 more per ounce tells me that Indian buyers don't trust they can get silver at the COMEX price. They know that if they want physical metal, they have to pay up. And they're willing to pay up because they believe silver is going higher. Think about that logic. You're paying $113 today because you believe that in 6 months or a year, silver will be at 130, 150, or higher. The premium you pay today is insurance against not being able to get metal at any price tomorrow. This is the mentality of a shortage. This is what happens in markets when supply can't meet demand. And here's the scary part. The shortage is only going to get worse. Industrial demand for silver is growing. Solar panel installations are accelerating globally. Electric vehicle production is ramping up. 5G infrastructure is expanding. All of these technologies require silver. At the same time, mine production is flat or declining. There hasn't been a major new silver discovery in years. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. So if those metal prices are low, mines produce less, and silver production falls. You've got demand going up and supply going sideways or down. That's a structural deficit. And deficits eventually lead to higher prices. But the COMEX doesn't reflect this reality because it's a paper market. You can create unlimited paper contracts. You can short silver on the COMEX without owning any physical metal. It's all just ledger entries in a computer system. The physical market, however, is constrained by reality. You can't create physical silver out of thin air. You have to mine it or recycle it. And if demand exceeds supply, prices have to rise to ration the available metal. What we're seeing now is the paper market and the physical market decoupling. The COMEX says silver is worth $93. India says it's worth $113. Who's right? In the long run, physical reality always wins. Paper can be manipulated, paper can be created, but physical silver is finite, and when people lose confidence in paper, they demand physical, and that's when prices explode. Let me walk you through what I think happens next, because we're at a critical juncture. First, watch the premium between India and the COMEX. If it stays wide or widens further, that confirms the physical shortage. If it narrows quickly, it might just have been a tariff-driven panic that subsides. My expectation? The premium stays elevated. Maybe it comes down from $20 to $10 or $15, but it doesn't go back to normal. Why? Because the physical tightness is real. Second, watch China. China implemented position limits on the Shanghai Futures Exchange recently. That means they're restricting how much silver any single trader can control. Why would they do that? To prevent manipulation and cornering of the market. But it also signals that Chinese authorities are concerned about volatility and supply. If China's silver price starts climbing toward India's level, that puts even more pressure on the COMEX. Because then you have two of the largest physical markets in the world pricing silver at 100 plus, while the COMEX is stuck at 93. Third, watch COMEX deliveries. We already saw backwards rolling in January. That's when traders roll their contracts from later months back to earlier months because they want immediate delivery. Over 40 million ounces were delivered in January, which is unusual for a non-primary delivery month. February delivery demands are sitting at about 11 million ounces right now. March is coming up, and March is one of the biggest delivery months. If March sees huge delivery demands and COMEX struggles to deliver, that's when confidence really breaks. Imagine you're a trader holding a March silver contract. You've been watching the India premium. You've been watching the vault withdrawals. You've been watching the tightness in physical markets. What do? You stand for delivery. You demand your silver, because you don't trust that you'll be able to get it later. Now multiply that by thousands of traders. That's a run on the bank. That's when COMEX either has to produce the metal or settle in cash. And if they settle in cash, they're admitting they don't have the metal. That destroys confidence. Once confidence breaks, the paper market collapses and physical prices go parabolic. I want to show you a historical parallel because this has happened before in other commodities. In March 2022, nickel on the London Metal Exchange exploded from $25,000 per ton to over $100,000 per ton in 2 days. A massive short squeeze. A Chinese trader named Shang Guangda had shorted nickel, and when prices spiked, he couldn't cover his position. The LME had to halt trading and cancel trades. It was chaos. Now, nickel and silver are different, but the dynamics are similar. When you have a mismatch between paper contracts and physical supply, and someone tries to corner the market or force delivery, prices can go vertical. Silver has a history of explosive moves. In 1980, the Hunt brothers tried to corner the silver market and drove prices from $6 to $50 in a matter of months. In 2011, silver went from $18 to $49 in a few months during the quantitative easing frenzy. Both times, silver moved fast, and both times, it was driven by fears of physical shortage or currency debasement. We're seeing both of those factors right now. Physical inventories are declining, and central banks are still printing money. The U.S. national debt is over $35 trillion. Inflation might come back. Geopolitical tensions are rising. All of this drives people toward hard assets like silver and gold. And here's the kicker. Silver is undervalued relative to gold. The gold to silver ratio is currently around 80 to 1. That means it takes 80 ounces of silver to buy 1 ounce of gold. Historically, the average ratio over the past century has been around 60 to 1. During precious metals, bull markets, it's compressed to 40 to 1 or even 30 to 1. If gold is at $2,600 per ounce and the ratio compresses to 60 to 1, that puts silver at $43 per ounce. At 40 to 1, it's $65. At 30 to 1, it's $86. But wait, India is already paying $113. So the gold to silver ratio in India has already compressed to about 23 to 1. India is pricing silver as if the ratio should be much lower than the historical average. Is India right and the COMEX wrong? Or is India overpaying in a panic? In my view, India is front-running what the global price will eventually be. They're paying today what they think will be the normal price 6 months from now. They're not overpaying. They're securing supply before it becomes even more expensive or unavailable. Let me give you another angle on this. The energy transition. The world is moving away from fossil fuels toward renewable energy and electric vehicles. That's government policy across most of the developed world. The U.S. Inflation Reduction Act is funneling billions into green energy. Europe is pushing hard on renewables. China is the global leader in solar and EV production. All of this requires silver, and I mean massive amounts of silver. A typical solar panel uses about 0.6 ounces of silver. Global solar installations are projected to reach 500 gigawatts per year by 2030. That's hundreds of millions of ounces of silver demand just from solar. EVs use about 1 ounce of silver per vehicle in wiring, contacts, and battery systems. If global EV production reaches 50 million units per year by 2030, that's 50 million ounces annually just from EVs. 5G build-out, medical technology, water purification, defense applications. Silver is in everything because it's the best conductor of electricity, the most reflective metal, and has antimicrobial properties. You can't replace silver in most of these applications. You could use copper, but copper is far less efficient. You could use gold, but gold is more expensive and not as conductive. Silver is irreplaceable in modern technology, and as technology advances, demand grows, but supply isn't growing. Mine production is flat, recycling helps, but it's not enough to make up the deficit. So we have a situation where structural demand is growing faster than supply. That's bullish long term. But in the short term, we have a price dislocation where paper markets are underpricing physical reality. India's $113 price is telling you what the equilibrium price probably should be if paper manipulation weren't suppressing prices. Now, I know some of you are thinking, this sounds like a conspiracy theory. You're saying the COMEX is manipulating prices? I'm not saying conspiracy, I'm saying structure. The COMEX is a futures market designed for price hedging and speculation, not physical delivery. Banks and traders can short silver on the COMEX to hedge their positions or speculate on price declines. That selling pressure depresses prices. But those shorts eventually have to be covered, and if they can't source physical metal to cover, they have to buy back contracts at any price. That's what creates short squeezes. Is it manipulation? That's a legal question, and I'm not a lawyer. But is it a structural flaw in the market design? Absolutely. When you allow unlimited paper creation in a commodity with finite physical supply, you create the conditions for violent price dislocations. And that's what we're witnessing. The paper market is breaking down, physical premiums are exploding, and the smart money is getting out of paper and into physical. JP Morgan has been accumulating physical silver for over a decade. Reports suggest they hold between 600 million and 1 billion ounces. We can't verify that, but we can see their COMEX vault positions. They're one of the largest depositories, and they withdrew 1.3 million ounces on January 16th. Why would JP Morgan, the smartest bank in the room, be pulling silver out of COMEX and paying for storage, insurance, and security to hold it? Because they know something. They know that physical is safer than paper. They know that premiums are going to explode. They know that silver is undervalued. When the big institutions move, you should pay attention. So what does all of this mean for you? If you own physical silver, congratulations. You're holding an asset that's becoming increasingly valuable and increasingly scarce. If you own paper silver, whether it's ETFs, futures contracts, or mining stocks, understand that you're exposed to counterparty risk, and you might not benefit from the physical premium that's developing. If you don't own any silver, this might be the signal that you should at least understand why it matters. Because silver isn't just an investment. It's real money. It's been money for 5,000 years. It's a store of value that doesn't depend on a government promise or a central bank balance sheet. And in a world where governments are running trillion-dollar deficits, central banks are printing money, and geopolitical tensions are rising, having some exposure to hard assets makes sense. I'm not telling you to run out and buy silver. That's not financial advice, and I'm not a financial advisor. But I am telling you to pay attention to what's happening. Because when markets fracture like this, when premiums explode like this, when inventories drain like this, that's usually the early warning signal of a major price move. And if you're not positioned ahead of that move, you'll end up being the person paying $113 when silver was available at $93. The India premium is your canary in the coal mine. It's telling you that physical silver is worth more than the paper price suggests. It's telling you that shortages are real. It's telling you that the COMEX system is under stress. How long can this continue? How long can you have a $20 premium between India and the US before something breaks? I don't know the exact timeline, but I know that markets don't stay broken forever. Either the premium comes down, which would require massive amounts of physical silver flowing into India, or the COMEX price goes up to meet the physical price, or we get a complete breakdown where the paper market and physical market become two separate things. My money is on option 2. The COMEX price eventually has to rise to reflect physical reality, because you can't hold a beach ball underwater forever. Eventually, the pressure becomes too great and it explodes to the surface. That's what I think we're seeing. The beach ball is starting to move. The pressure is building. And when it breaks the surface, the move is going to be fast and violent. So keep your eyes on India. Keep your eyes on China. Keep your eyes on COMEX deliveries. Because this story is just beginning. The $20 premium today might be the $30 premium next week, or it might normalize. But the trend is clear. Physical is king, paper is suspect, and the smart money is moving into the real thing. Thank you for watching The Hidden Economy. If this analysis helped you understand what's happening in the silver market, smash that like button. Subscribe and hit the bell so you don't miss the next update. Leave a comment and let me know. Do you think the COMEX price is real, or is India showing us the true value of physical silver? And remember, in markets, information is power, but only if you act on it. Stay informed, stay ahead, and I'll see you in the next one.